Okay, picture this. You've got Warren Buffett, Peter Lynch, and Benjamin Graham, the ultimate investment dream team, all sitting in a room together. You slide the exact same first quarter 2026 data for ExxonMobil across the table. So, the million-dollar question is, would these legendary market masters actually buy this megacap energy stock today? Welcome to this explainer. I am super excited to walk you through this one because today we're putting ExxonMobil through what I like to call the ultimate stock gauntlet. We're going to put on our expert investment analyst hats and run XOM's Q1 financials through the very specific valuation lenses of these three gurus. Plus, we'll throw in a few modern intrinsic valuation models for good measure. All right, let's just dive right in. Here is our roadmap for the gauntlet. We'll kick things off with a quick snapshot of ExxonMobil, then we'll sequentially apply the Buffett lens, the Lynch lens, and the Graham lens. After that, we'll run a discounted cash flow and some other models, and finally bring it all together for our synthesis and final verdict. Let's go. Section 1. Setting our baseline with a snapshot of ExxonMobil's Q1 2026. First things first, the price. Right now, as of our analysis, ExxonMobil is trading at $136.06. I want you to lock that number in your brain. That's our anchor today. Because every single framework we run from here on out is basically trying to answer one simple question. Is the actual intrinsic value of this company higher or lower than that $136.06 price tag? So, pulling the raw numbers straight from their Q1 8K filing on May 1st, 2026, we are looking at a truly massive footprint. They pulled in $4.2 billion in earnings for the quarter, which breaks down to $1 a share. Total debt is sitting at $47.7 billion, and they declared a quarterly dividend of $1.03 per share. So, those are our foundational numbers. Moving on to Section 2, the Buffett lens. This is all about blending high quality with deep value. Now, Warren Buffett's checklist is famously strict. He wants to see a clear economic moat, incredibly consistent earnings, a high return on equity, and easily manageable debt. On the qualitative side, Exxon passes this no problem. Its global scale and integrated supply chain across 180 countries, yeah, that is a massive moat. The debt is also super manageable. Actually, their net debt to capital ratio is lower than literally every other integrated oil company out there. And for profitability, looking at their FY25 data, they're posting a solid return on equity of around 10.8%. So structurally speaking, the Oracle of Omaha would definitely be nodding his head. But Buffett, he doesn't just look at standard GAAP earnings. He cares about owner earnings, right? The actual cash you could take out of the business. We can get a rough idea of this by taking their Q1 operating cash flow of $8.7 billion and subtracting the $6.2 billion they spent on cash capital expenditures. That leaves us with $2.5 billion in free cash flow, or owner earnings, just for that single quarter. That is a mountain of cash, but we have to weigh it against the sheer overall size of the company. Which brings us to our first verdict. While Exxon is an absolute powerhouse of a business with an undeniable moat, Buffett is obsessed with getting a steep discount, his famous margin of safety. Earning $2.5 billion in a quarter is great, but at a share price of $136, the current free cash flow yield just doesn't give you that deep discount he usually demands. So, at this specific price, it fails Buffett's margin of safety test. All right, Section 3, let's look through the Peter Lynch lens. Peter Lynch is all about categorizing a stock to understand exactly what you own. And under his framework, Exxon is kind of this fascinating hybrid. It's a stalwart because of its gigantic size and slow, steady baseline growth, but it's also highly cyclical because its fortunes swing wildly with global commodity cycles. Lynch would tell us point blank, you do not buy a mature cyclical stock expecting crazy tech-like multiples. You buy them when their balance sheet is flawless and the cycle is about to turn. And speaking of flawless balance sheets, Exxon's financial armor is pretty unbelievable. Their long-term debt-to-equity ratio for Q1 is just 0.13. To put that in perspective, industry data shows that is the lowest among all integrated oil and gas operations right now. Lynch absolutely loved a pristine balance sheet, so Exxon aces this part of his test with flying colors. But there's a catch when we look at Lynch's favorite metric, the PEG ratio, where you divide the PE ratio by the growth rate. A mature, cyclical giant like Exxon usually only has low single-digit baseline growth. So even if the PE ratio is moderate, dividing it by such a small growth number makes it really hard to hit Lynch's ideal PEG ratio of 1.0. The only way it gets there is if massive tailwinds in oil prices artificially spike that growth rate. Okay, Section 4. Time for the most brutal quantitative test of them all, the Graham lens. Let's run Benjamin Graham's defensive investor checklist. Adequate size? Easy pass. Strong financial condition? With that 0.13 debt-to-equity ratio we just talked about, definitely a pass. Earning stability? Check. Dividend record? This one is just staggering. They've grown their annual dividend for 43 consecutive years. Huge pass. The only real mixed bag here is ensuring a moderate PE and price-to-book ratio, which leads us right into his valuation formula. So let's get into the math. Graham's legendary intrinsic value formula. It's the square root of 22.5 multiplied by the earnings per share multiplied by the book value per share. Based on our data, we'll assume a trailing 12-month EPS of roughly $5.93 and calculate a book value per share of $62.11, which we get by dividing their $261 billion in total equity by the average shares outstanding. When you crunch all those numbers together, Graham's formula gives us a hard intrinsic value of exactly $91.03 per share. So what's the verdict for the father of value investing? It's a hard fail at current levels. Graham was notoriously strict. He wouldn't just refuse to buy at $136, he'd demand his margin of safety be priced well below that $91.03 ceiling before he'd even glance at the buy button. Let's move to Section 5, Discounted Cash Flow and Other Forward-Looking Models. Setting up our DCF is pretty straightforward. Step 1, we'll take a conservative base free cash flow of $10 billion annualized, based on Q1 and historical averages. Step 2 is forecasting that growth out over the next 5 years. Step 3, we peg the terminal growth rate at 2%, basically assuming this mature giant just keeps pace with standard inflation forever. And finally, Step 4, we discount all those future cash flows back to today's dollars using an 8% weighted average cost of capital, or WACC. Now, we know assumptions can be tricky, so we ran a sensitivity matrix. Just tweaking that discount rate by a single percent totally shifts the fair value, generally landing Exxon somewhere in the 110 to 130 range. But, and this is super interesting, if we switch gears to a dividend discount model, which values the stock purely on its incredible dividend history, and we assume a modest 5% dividend growth rate, the valuation shoots up to $144.20. The DDM absolutely loves that 43-year track record. Section 6, our synthesis and final verdict. Let's bring all these pieces of the puzzle together. When you stack these different valuation methods side by side, you get this really fascinating tug of war. The stock is currently trading at $136. The deep value purists using Graham's formula are saying, nope, the ceiling is $91. But the income-seeking investors using that dividend discount model are looking at the cash returns and saying, actually, this is worth up to $144. So, putting on our expert analyst hats, what is the final verdict? At $136, we're calling it a hold. Look, it's a remarkably robust, shareholder-friendly business, but the current price has a lot of optimism already baked in. If you're wondering when our gurus would jump in, Graham would likely pull the trigger around $60 to guarantee his margin of safety. Buffett might start snooping around if it drops to the $100 mark. And for Peter Lynch, the buy trigger isn't about a specific price at all, it's entirely about correctly timing the bottom of the next macroeconomic cycle. I want to leave you with a provocative question to chew on. We've seen that Exxon has literally the lowest debt in its entire industry, plus an incredible 43-year history of growing its dividend. After running this entire gauntlet, do you think a world-class, bulletproof balance sheet justifies paying a premium over Benjamin Graham's strict intrinsic valuation in your own portfolio? It's the kind of question every serious investor has to figure out for themselves. Thank you so much for joining me for this explainer, and keep learning.